And that is, it's not gold going up, it's paper currencies going down. These levels on the ratio are just absolutely crazy. And as gold goes up, silver will go up twice as fast to bring that ratio down to something which is, if you like, more sensible. Yeah, 2024 was interesting. 2025 is going to get even more interesting.
Our goal was down, falling stock market, recession, maybe a financial crisis. There could be a financial crisis early in Trump's first year. The fact that these stocks are down so much shows you how negative the sentiment is in gold. But how negative the sentiment is in gold, that's how positive it is.
And to push silver below $30, it was, this is what they've been trying to do. And I think you'll see it turn right back around because all of those short positions get covered and it goes right back around. What you will see is massive managed money selling and commercial banks taking the other side of that and going long. And, this is an environment where this is as big of an opportunity as I think you'll ever find in precious metals because nothing has changed whatsoever. Nothing.
In today's news recap, gold holding $2,600 ahead of shortened holiday trading week. Despite ending the week in negative territory, the gold market managed to hold critical support at around $2,600 an ounce, even after the Federal Reserve signaled it would slow the pace of rate cuts in 2025. Gold struggled during the last full trading week of 2025 as investors prepared for the Federal Reserve to announce a hawkish rate cut. As expected, the central bank cut the Fed funds rate by 25 basis points. However, updated economic projections revealed that forecasts for interest rates, also known as the dot plot, indicated only 2 rate cuts next year, putting rates at 4%. In September, the Federal Reserve had forecasted 4 rate cuts for the new year. Analysts note that gold could still face challenges in this environment during the shortened holiday trading season. Commodity analysts at TD Securities said in a note Thursday that the path of least resistance for gold could be lower in the near term. While we do not expect a rout, given uncertainties surrounding Fed policy, should inflation continue to be higher than expected and the economy start to slow at the same time, new geopolitical risks, and a renewed round of central bank buying, somewhat lower prices are still likely in the near term. It would not be surprising to see prices drift down to the November lows of $2,537 per ounce, the analyst said. However, other analysts see gold caught in a tug of war between the Federal Reserve's monetary policy and geopolitical uncertainty. Gold managed to hold critical support Friday after the U.S. Congress was unable to pass a spending bill before the holidays. The government is once again on the brink of a partial shutdown that will affect everything from border enforcement to national parks and furlough up to 2 million employees. Now we'll show you the best clips of the latest interview, but first hit the like button, smash the subscribe button, and check the pinned comment because we're offering an exclusive discount on NordVPN, an essential tool for gold and silver stackers who value privacy and security. Make sure you safeguard your online activity and protect yourself from prying eyes. And if you want to learn how to stack and how you can benefit from the gold-silver ratio to make savvy investment decisions, check our guide at goldsilverstacks.com. Enjoy the episode.
I had 1 or 2 friends, not very many, in the LBMA, and I was talking with one of them some time ago, and he admitted that he never ever looks at economic factors. He doesn't understand, sort of money, all that sort of stuff. I mean, he just trades the stuff. He was making some pretty good forecasts on the basis of his experience as a trader, but I think this is really what it's about. We're moving from the days when, you could just trade gold. If you're a bullion bank, you're probably running a short book. So what you do is, you trade it, and every now and then the punters, hedge funds get a bit overextended. You can bang it and trigger all the stops and get your position back and all the rest of it. That's not happening now. And I think that's the big difference. And the reason it's not happening is because there are bigger forces at play. I think it's probably surprised a lot of people that despite the price rise, the Chinese are continuing to buy. And so are other central banks. So what's all this about? Well, the answer is quite simple. And that is, it's not gold going up, it's paper currencies going down. And this is very, very important. It's very important to get this message early, because when the general public finally realizes that it's not the price of eggs or the price of coffee or whatever going up, but actually the purchasing power of their currency going down, then the currency is doomed. And when the general public wakes up to it, I can tell you the dollar, sterling, euro, yen will all be a lot lower. Now, I put it that way rather than saying gold is going to be a lot higher, because if you think as an investor, you look at gold and you think gold's gone up. As we talk, I don't know what it'll be when this is released, but as we talk, it's had a good day. I see it's up $18. It's currently trading at 2,712. Challenging the levels we saw, 4 weeks ago. If it breaks that, then it's going to go and hit new highs and so on. But do we really want to pay this much for gold? Perhaps we should hang on and wait for a decent shakeout. It's gone too far. But the point they miss is it's not gold going up. It's the currencies going down. Now, obviously, nothing goes down in a straight line or in an even tempo. But I think if you understand that, then you understand that really what your strategy should be is not trading it, but actually accumulating it, and accumulating the physical, not paper. Now, this is a very, very important point. And of course, the whole of the investment industry has a difficulty here because gold is not a regulated investment. So how do you get it past your compliance officer? Well, the answer is you go out and buy ETFs. But your problem with the ETF is you don't own the gold. And worse than that, not only do you not own the gold, you don't actually own the shares in the ETFs unless you have specifically decided to take delivery of certificates. Now, this is a very important point, because the owner of, or if you like, the owner of the certificates, in effect, is, the clearinghouse, the intermediary, the big boys in the middle, basically, who guarantee settlement, Euroclear, whatever. And why have they got it? Well, the answer is quite simple. You've got a huge, great derivative mountain, which is absolutely enormous. And the fear is that at some stage we get a crisis and that could be jeopardized. So what they want is they want your stock to have as collateral to deliver in order to ensure that that whole mountain of deliveries of derivatives doesn't collapse. So, ETFs don't get you out of it. The answer basically, I'm afraid, is you've got to accumulate coin and bars, both gold and silver. Silver I regard as gold on steroids, because the gold silver ratio is just crazy. At 85 or something as we speak. This is nonsensical. I don't see it going back down to the sort of 15, 16, if you like, when when silver was treated or valued as money.
In today's news recap, gold price sharply down on Fed's surprisingly hawkish pivot. Gold and silver prices are strongly lower in early U.S. trading Thursday, following a surprisingly hawkish turn from the U.S. central bank Wednesday afternoon. Gold prices hit a 4-week low, and silver prices a 3-month low. February gold was last down $39.10 at $2,614 $29.20, and March silver was down $1.12 at $29.61. U.S. stock index futures have rebounded, and U.S. Treasuries have steadied overnight after the Federal Reserve's surprisingly hawkish pivot on U.S. monetary policy Wednesday afternoon. While the Fed announced a 25 basis point interest rate cut as expected, the FOMC's quarterly summary of economic projections showed the majority of FOMC members now expect just 50 basis points in rate cuts in 2025. That's a major change in the FOMC's thinking since the last dot plot meeting in September, when the FOMC forecast was for 100 basis points in rate cuts in 2025. The hawkish pivot sunk precious metals, saw a big surge in the U.S. dollar index and in Treasury bond yields. Fed Chairman Jerome Powell said in his post-FOMC press conference, "This is a new phase where inflation concerns are back on the table." While the new policy setting is still meaningfully restrictive, that's what it needs to be, because inflation remains above the 2% target, he said. "We still have work to do to bring down inflation," said Powell. Asian and European stock indexes were mostly lower overnight. U.S. stock indexes are pointed toward firmer openings when the New York day session begins, on a modest rebound following Wednesday's sharp sell-off that pushed the S&P 500 futures to a 6-week low, saw the index suffer its biggest Fed decision day loss since 2001 and the biggest one-day loss since the pandemic in 2020. Meantime, a stopgap U.S. government funding deal has fallen apart following opposition from President-elect Trump, increasing the likelihood of a government shutdown this week. If the debt ceiling isn't raised and the U.S. government shuts down, that would definitely lead to chaos, said a Bloomberg report. U.S. equities may be hit, but any spike in U.S. yields may drag down rest of the world, said the report. Now we'll show you more clips, but first, smash the subscribe button and check the pinned comment to get yourself the best VPN deal on the market. You'd be crazy not taking advantage of NordVPN to safeguard your privacy at these prices. Enjoy the episode.
There's a huge disconnect right now between economic reality and this economic fantasy, but it has caused this upward trajectory in the dollar. Again, I don't know how much higher the dollar is going to go than it is right now. I mean, it certainly could move higher, and that could put more downward pressure on gold. But, remember, in terms of foreign currencies, gold is holding up. And, it's not up $30 anymore. It's up $24, but it's still back above 2,600, 2,608. Look, I think gold is acting very, very strong. I read an article that the Chinese have been buying up a lot of gold recently. They're not talking about Bitcoin. They're buying real gold, and they've been buying a lot more than they've been letting on. I know there were some rumors, the Chinese don't want to buy gold now that Trump is there threatening them with tariffs. You know what? That means they want to buy even more gold. Whatever the U.S. doesn't want them to do, that's exactly what they're going to do. So take advantage of the weakness in gold. Silver also got hit. It's back below $30 right now. It's at $29.50. I don't think it's going to stay below 30. Again, I think this is where the support is in silver. So we should be buying the dip. You should be calling up the guys over at Schiff Gold, or just going onto the Schiff Gold website and fill up your shopping cart, with gold and silver while they're on sale. And I know that we're seeing the foreign markets coming down, mainly because of the dollar going up. So a lot of the weakness in the foreign markets is currency related, but I think stocks are going to go down a bit too, in sympathy with the U.S. stock market. But the U.S. stock market is a disaster waiting to happen. And the only way to avoid that disaster is to create a bigger disaster in the dollar. So either the stock market crashes or the dollar crashes. One of those two things is going to happen. I think it's the dollar, although the stock market will go down first. And that's one of the reasons that the Fed is going to go back to QE. The Fed is going to sacrifice the dollar to prop up the stock market and the economy and the bond market and the U.S. government. All that's coming. So in the meantime, just keep on buying these foreign stocks. I keep on adding, I think, to your Pacific accounts. Keep on taking money off the table in the U.S. stock market. I know people just think, hey, it's going to be great because Trump is president. Look, yes, it's better that Trump is president than Harris. The market was going to go down with Harris. The market was going to have to go down either way because the market was so expensive. But the worst of the economic downturn, the worst of the consequences for the years of fiscal and monetary profligacy, they had yet to be paid. That was going to happen. This was, guaranteed. It was assured to happen. And, that was one of the concerns I had for Trump, was that it all blows up on his watch. But one of the reasons I did want Trump in the White House when it hit the fan was because it would be much better to have Trump and his team than Kamala and her team in the aftermath of the collapse. Not because I thought that electing Trump would prevent the collapse. I just thought that electing Trump would put us in a better position after the collapse to do the right thing. Money is cheap. The real rate of inflation is much higher than the government admits. We have negative real interest rates. If you put a real inflation rate and then discount those interest rates, debt is at record highs. Everybody is borrowing. I said, government has never been borrowing as much money and spending as much in deficits as it's doing right now. Could the government be this reckless if we had tight money? Of course not. That's the point of tight money, is to force everybody to tighten their belt. No one's tightened anything, right? In fact, they've gotten rid of the belt. They removed the belt and untucked their shirts, right? This is easy money the whole time. That's why we've got, on pace maybe for a $4 trillion budget deficit. So it's excess on Wall Street, excess debt and credit on Main Street, because the Fed never got into restrictive territory. Now, why? Why did the Fed stop well before rates ever got restrictive? Because the wheels started to fall off the bus. Signature Valley Bank, Silicon Valley Bank, or Signature Bank, Silicon Valley Bank went belly up. The dominoes started to fall, and they would have kept on falling had the Fed kept on hiking. Well, they stopped hiking, and they, stopped the financial crisis. Well, now that they've taken away a lot of the easing, this is like a hike, right? Even though the Fed cut rates today, for all practical purposes, they just hiked them, right? Because they're less loose. They took away some of that punch bowl. And so I think this is like a hiking cycle that the markets didn't expect. And so we're going to resume the financial crisis that was interrupted when the Fed stopped hiking. Now that they've kind of started a tightening cycle, we're going to resume that financial crisis. Look at the industrial production numbers that came out. These are horrible numbers. Industrial production dropped by 0.1%. Dropped. So we got a booming economy. We got a remarkable economy, and our industrial production is going down.
In today's episode, Andy Schectman dives into the art of stacking gold and silver the right way. He emphasizes that successful stacking isn't just about accumulating metals. It's about a strategic approach that ensures long-term security and financial resilience. Schectman stresses the importance of prioritizing physical metals over paper-based assets, noting that true wealth lies in tangible ownership. He also highlights the value of balancing gold for stability and silver for its growth potential, helping stackers build a well-rounded portfolio to withstand economic challenges. Schectman shares his bullish outlook on precious metals, citing critical macroeconomic factors like rising inflation, unsustainable government debt, and the global trend of de-dollarization. These, he explains, are driving demand for gold and silver as essential hedges against economic uncertainty. He is particularly optimistic about silver, praising its unique dual role as a monetary asset and a key component in green technologies like solar panels and electric vehicles. With industrial demand poised to surge, Schectman believes silver's potential is unmatched. Now we'll show you the best clips of the latest interview, but first, first, hit the like button, smash the subscribe button, and check the pinned comment. We're offering a big discount in NordVPN, which is an essential tool if you want to browse the internet in a secure and private way. For just a few dollars a month, make sure your privacy is never compromised.
This is a risk-on environment until it's not. Maybe another day or two like this will change. Hey, knock it off. I just got a puppy. I'm sorry, you guys, and the puppy and the other dogs are getting to know each other. Of course, no one's home right now, so I'm stuck with all three of them. I apologize, and that may happen again, so I'm sorry in advance. Look, I think in the end, guys, metals are going to go a whole hell of a lot higher. This was something I think, that we should have expected. This is a market where we had massive short positions in London and in the US by the commercial banks that were hugely underwater. And I think they used this optimism as an opportunity to right their balance sheet and to push silver below 30 bucks. It was, this is what they've been trying to do. And I think you'll see it turn right back around because all of those short positions get covered and it goes right back around. What you will see is massive managed money selling and commercial banks taking the other side of that and going long. And, this is an environment where, to me, this is as big of an opportunity as I think you'll ever find in precious metals because nothing has changed whatsoever. Nothing has changed. And the commercial banks and the bullion banks and the central banks are doubling down what they're buying. They're doubling down their efforts, and they are using the stupidity of the Western suppression of the paper markets to do just that. So I would say that this should have been expected, maybe not as severe as we thought. But I do think that for the most part, if I had to bet, the worst of the drop is behind us now that we've broken below these numbers. Those short positions will have been covered, and I think you'll see the market turn up from here. More acute in silver than it is in gold. And if you look at the stockpiles of the metals that are being held at the LBMA, at the COMEX, and even at the Shanghai Metals Exchange, they are drawing straight down. And what's different now over the last few years, and I would say it started really in 2020, than any time that people have been following this market. And look, I go back to 1990 following this market. That's when I started in this industry. For my entire career, no one stood for delivery. Never. I mean, less than 1% of the contracts did. But this is what's different now. And these countries are smart enough to be methodical about it. So they're standing for delivery. They're draining the LBMA. They're draining the COMEX very slowly, very methodically. If you do it too fast, you get a force majeure. You get some sort of a default and the whole thing blows up. You cut off your nose to spite your face. Instead, they play the game with the West. And the game that the West has played is to support the illusion of the strength of the bond market, the strength of the currency. And they never counted on these countries being coordinated, sophisticated, motivated, and wealthy enough to stand for delivery, but also smart enough to do it in a methodical fashion, to not raise the red flag fast enough. But I think in the silver market, look, there's a 4 to 6 billion ounce shortfall in London. 4 to 6 billion. That's why they tried so hard to drive the price down here into the end of the year, closing out the stops, letting their balance sheet kind of level off, and they'll take the other side of that. And there's between 700 and 750 million ounces short on COMEX. Most of this is naked, meaning there's nothing behind it but a big checkbook. And so they've been able to keep the game going for a long, long time, but it ends when the rest of the world continues to buy metals because they don't want our treasuries anymore. So when you asked me earlier about what I consider to be financial warfare, the supposed tariffs, they're not, they're sanctions. This is exactly what will continue to make these countries want to continue to use the Achilles heel of the West against us, the short positions on these commodities and the delivery availability. So look, they have enough money to blow it up all at once, but then the game's over. So they're slowly draining the exchanges, not so fast that the whole game ends, but fast enough to see a massive drawdown. You look at the LBMA stockpile of silver, it's a 45-degree angle, and it's falling in on COMEX too. Gold a little bit slower, but it will happen the same way. And I think what will ultimately happen is that the exchanges in the East will take over for the COMEX and the LBMA. They will be rendered a scam. They will be rendered a fractional reserve system. We're not there yet, but I think that there's no question that they understand what we're doing, and they understand the way to win is to use that leverage against us and to do it in a way that doesn't, or allows them to continue to do it as long as possible. That's why they're not bitching. They're not pitching because they understand, but they're the ones accumulating, and we're foolish enough to let it go at stupid prices.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the US dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the Stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.